It's Brian Preston, the money guy.
So the whole point we're talking about is, okay, well, what is a reasonable rate of return? We saw some unrealistic expectations. We talked about Vanguard's maybe conservative trying to set expectations low. How does one go about determining what is a reasonable rate of return, or how do we calculate a reasonable rate of return?
Well, I wanted to put another thing up on the screen. Morph, give me 2 seconds to get it on there. So I went and I said, well, what's a good average stock market return?
Okay.
So if you went to NerdWallet, they had a piece that just came out. I mean, this is like just a few weeks ago, March 7th, basically last week. March 7th, they came out with this piece of what is the average stock market return.
Kind of sounds like what we're talking about right here.
Yeah, so from 1926 to 2014, I mean, it was talking about as 10%. It said the S&P 500 is around 10%, and most people look at it to have bands between 8 to 12%. But the problem, and this is something we talked about in an Ask the Money Guy segment we just did earlier today, is that there's only, since in that 1926 to 2014 period, that's a long period of time, there's only been 6 times that it actually lands in that 8 to 12%.
So I want to say that again. You said the average stock market return was 10%. It normally falls somewhere in the 8 to 12% band, but in all of those years, almost 100 years, 88 years, I think, if I did my math right on that, it only fell into that band on 6 different occasions from an annual
So volatility is definitely something you need to understand and appreciate and expect when you invest in the equity markets.
And I think it was this article that said average market returns aren't always average.
Exactly.
That's right.
So that's something just to keep yourself straight on understanding that averages just don't happen that much.
That's right.
And then we couldn't close this segment out without talking about the Dow bar behavioral impact, because we know that behavior is going to come into play, because I could tell you the S&P 500 makes about 10% a year. But does that mean that's what the average investor gets? No, because what happens, I should have done the market cycle of emotions, because what happens is the typical investor, when things are looking great, where markets are hitting all-time highs, that's when people are loading it up. Mm-hmm. They're getting all into it because they don't want to miss out. That whole FOMO thing kicks in. When markets are getting their teeth kicked in, and we all should be running in to get into this thing as much as we can.
Everybody's trying to
get the heck out of it, and you see cash spike during those periods. So you have to take into account behavior. So let me just give you some stats. This is only a 20-year period. So that's why you'll notice the S&P is a little different on their 20-year period versus going back and looking at what NerdWallet did from 1926. Their average equity fund investor makes about 5.29%. Now, this is as of the 2018 Dow Bar Quantitative Analysis of Investor Behavior.
Okay.
The average fixed income investor, right at 0.44%.
Right at 0.5%.
The average asset allocation fund, that's what I would think is probably like a 60-40 or target retirement, 2.58%. Wow. None of these are anywhere near where we've talked. Yeah. And then inflation was at 2.15 over this 20-year period. And then the S&P 500 was 7.2%.
So it's really interesting. The average equity fund investor, who you would imagine probably is pegging themselves to the S&P, some pretty significant underperformance relative to just buying the index.
So what is a reasonable rate of return? I will tell you, I think the answer is it varies by what your actual need is.
That's right.
And that's what I want to get into now, is talking about what is the type of return that you need, not something you just randomly pulled out of the air because you saw what the S&P 500 did, or you saw that list from 1999 where you had 10-year averages that were over 15, over 20%. I want you to understand what is a reasonable rate of return and how it is so custom and should be built upon what your needs are.
So you're saying a reasonable rate of return for any individual investor is very much specialized to that individual investor.
So we have to figure out what influences your rate of return. Let's transition and kind of talk about those things, because your heads are probably spinning a little bit. I've thrown a lot of numbers out there. So I want to now bring this back to you as an individual so you can have a better understanding of rate of return and how to design a portfolio that kind of captures what's required for you to meet and have the life that you want, that checks the box on all the goals, that actually has enough money for you when you want to actually be financially independent, and then also helps you know, should I be taking more risk or should I take my foot off the accelerator of risk and bring it down? All these things need to take into account where you are in your financial life. So the first thing is, return and rate of return is a two-faceted metric.
That's exactly
Bo,
right.
you're our investor specialist. What is it? What do I mean by that?
Yeah, so return is generally comprised of two different pieces. There's generally income return, there's capital appreciation return. Here's a really easy way to think about it. If you buy something that's worth $10, one way you can make money is if when you sell that at some later date, it's worth $12, you have $2 of capital appreciation. That's one component of return. Well, another component of return is sometimes we can invest in things that pay cash back to us, like dividends or like coupon payments for a bond, where I may invest $10 and I may get a dividend of $1 back to me, paid directly to me. That's an income component. So there are two different pieces, yield and appreciation.
Is it good to focus on? I had to make sure we're running at 20,000 because I hear it over there ticking. You guys are doing good on getting to 20. But here's the thing. Should you focus on just yield? Because let me put this in some context, Bo. There are whole strategies out there for people who are in their 50s, 60s, and 70s, where when they get to that retirement age, they start thinking, should I focus only on the income the yield, or should I let it be more all-consuming of focusing on all areas of the return?
Yeah, we think that what makes the most sense when you're looking at designing a portfolio or thinking about how you capture return, total return is what makes the most sense. It should have various components of income, but also various components of capital appreciation. I can tell you, we did the Money Guy Misses a few weeks ago where we talked about these big investing mistakes that we made. One of the things that I did very early on when I bought my very first stock or when I bought my very first bucket of stocks is I went and looked through Yahoo Finance and I picked a stock that had the highest yield on it, like a 13% dividend yield. Because in my mind, I told myself, oh, well, that's a guaranteed 13% rate of return. How is that ever going to go bad? Well, a 13% yield doesn't do you a whole lot of good if the stock price drops by 20%. You've lost money.
Here's what Bo and I were talking about this in pre-show planning, is that we were talking about how typically whether you're talking about bonds on fixed income or dividends with stocks, the higher the income or the yield, probably the more risk you're taking.
That's right.
I'll give you the example on fixed income. Think about it. Junk bond or high yield fund. Junk is kind of, it's high yield is the fancy way, but it's really junk bonds.
Sure.
It means that they're riskier investments on the bond side. Is going to yield substantially higher than a classic Coca-Cola or some other company, a treasury or something, if you're talking about a government security. It's because you're paying, they have to pay you more for the additional risk you're taking on. Right. Same thing with dividends. Does a company, think about, does the dividend of a Procter & Gamble or a bank have to be the same for a high flyer like Tesla or something like that? The difference is there's more risk involved with the higher paying dividend.
That's exactly right.
So not that Tesla pays a dividend, but I'm just saying, but you had a software company.
A software company that had
a software company that was paying a 12% dividend. Intel is not paying a 12% dividend.
So you can naturally assume that company is further out on the risk spectrum than maybe one of the blue chips. So you can't just chase yield, just chase income and think that you're staying in the conservative side of the portfolio, because that's not always the case.
Yeah. When I threw out the Tesla thing, Tesla was on the brain. I should have been thinking Tesla bonds are going to be higher than like a Coca-Cola bond, but the dividends, bringing it back in context. I didn't want people thinking, Tesla is paying dividends?
Own any Tesla?
No. We want to make sure we keep that straight. Also, there's also an impact by inflation. I think when people chase yield, how often, I hear this so often, Bo, and I want you to kind of share what we found when we did research. People said, they hear that bonds back in the early 80s were paying double digits. Yeah. Treasuries were paying double digits, and they're like, I would have just bought a whole portfolio of that, and then I'd have no risk. What do we always have to share them to give them context?
Yeah, the problem is that there is an equity risk premium associated. So you can assume that if interest rates or if rates on treasuries or safer investments like that, if yields are so high, the chances are two things are happening. One, equities are returning some number higher than that because of the premium that you pay. And two, inflation is probably rampant. We did a really easy example. Would you rather have a 10% rate of return or a 6% rate of return? Well, most folks would naturally say, oh, I would much rather have a 10% rate of return. That's a useless metric unless you understand how inflation affects that. You'd much rather have a 6% rate of return with 2% inflation than a 10% rate of return with 8% inflation. Your real rate of return, how much your dollars are growing in terms of purchasing purchasing power matters.
I thought it was because we had read in a research piece by a blog post by, I can't remember David's last name, but I loved how he mentioned that in 1980, an example of inflation was if somebody was going and getting a yield of 11% out of a treasury bond, that sounds great. But then you find out inflation was at 14%.
You're losing purchasing power.
You're actually losing money. So that just gives you perspective is when you think about rate of return, you got to make sure you understand the component of inflation too. And then I like to always talk about tax efficiency.
Of course you do. You're the CPA. Well, why wouldn't you want to talk about tax efficiency?
Well, one of the big things, when you design a portfolio and your rate of return, you need to think about, we talk about asset location. Mm-hmm. You want to put your bonds in the tax-deferred accounts, like your retirement accounts. You want to put your growth assets into like your Roth IRA so they can be tax-free growth. You got to be taking that stuff into account because that has a direct impact on your rate of return because there's two things that impact your rate of return is taxes and how much in fees you pay. Exactly. So you've got to be paying attention to how tax efficient things are. Now, we talked about this. Another example we'd been reading recently was somebody talking about they had a portfolio that could yield 10%.
Okay.
Was it better if that yield was paid out as a 10%, like, let's say as an interest rate?
Like an income on that.
So if you had, if you could have $1,000 invested making 10%, is it better to get that $100 as interest, or is it better if it actually appreciated at 10%?
So I think someone who has no context for what we're talking about, they say, oh, it's the same. Whether I get $100 in income or $100 in capital appreciation, it's the exact same thing. It's a 10% rate of return.
That's cute, but Uncle Sam doesn't look at it that way. Because if you think about it, if you have to, when you file your taxes at the end of the year that you made 10%, you're celebrating like hot dog, I made 10%. Right. And we're going to keep the number simple at $1,000. So that $100 of income, guess what? It's taxable.
That's exactly right.
Uncle Sam's going to want your cut at ordinary income tax rates on that 10%.
Yep.
If you bought something for $1,000, it appreciates 10%. At the end of the year, when you go to file taxes, like you bought an S&P 500 index fund, assuming we'll take the dividends out of this analysis, we just want to talk about the appreciation of that 10%. Right. When you file your taxes at the end of the year, you don't owe the government $1 of taxes on that 10% of appreciation. It is worth $100 more than it was at the beginning of the year.
What I think is so interesting is, you know how I know that we're on to something? This is a little bit of a teaser for a show that's coming out in the near future. If you read through Warren Buffett's most recent letter to shareholders, which we're going to be covering in an upcoming show, one of the things that he talks about is there is some juice that exists at Berkshire Hathaway because he's able to have unrealized gains across his $173 billion investment portfolio. You guys as individual investors get that same benefit from not having to pay tax on that. So it's a very efficient way to grow your assets through time.